Ever click buy and pay more than you expected? That's called slippage. When you place a trade, the price can change before it goes through, especially if the market's moving fast or if the coin isn't very liquid. So even if you clicked at $1, it might fill at $1.05. It's like trying to buy concert tickets, but someone grabs the last seat just before you hit confirm, and the next best seat costs a little bit more. So, next up, why liquidity makes slippage worse or better. Why is it so much harder to buy or sell small coins? That's liquidity, how easy it is to buy or sell without changing the price too much. Big coins like Bitcoin and Ethereum have tons of buyers and sellers, so trades flow smoothly. But small coins or tokens, there are just fewer people, there's less flow, and there are more price jumps. A coin runs its own blockchain, like Bitcoin or Ethereum. A token runs on blockchain, like Link on Ethereum. Small cap equals low volume and fewer trades, which also equals more slippage. Selling gas at a truck stop is easy and cheap, but in the desert, prices skyrocket. Up next, the kind of order you place actually matters. Are you buying bread or making a deal? When you place a market order, you're saying, I want it right now, whatever it costs. It gets filled instantly, but the price might be higher than you expected, especially if the market is moving fast. A limit order is more like setting a boundary. You say, I'll only buy if the price drops to 350, no more. You're in control, but you might have to wait. Sometimes it never fills at all. Market orders are all about speed. Limit orders are all about control. Neither is wrong. It just depends on your goal, your patience, and the risk you're willing to take. The comparison is grabbing bread off the shelf right now. That's a market order. Waiting for a sale and hoping it comes? That's a limit order. Next, crypto doesn't wait for you. Let's talk volatility. Why does crypto feel like a roller coaster on rocket fuel? Volatility means the price of something can change, and not just a little. In crypto, those changes are fast, sharp, and often extreme. 1 minute, you're up 5%, and before you finish your Diet Coke, you're down 12%. It happens because crypto markets are young, emotional, and easily swayed. There's less money holding everything stable, so prices move harder and faster than in traditional markets. A single tweet, a whale trade, or breaking news can send a coin soaring or crashing. This isn't the same as the spread, which is the gap between buying and selling prices. And it's not the delta, which measures the power struggle between buyers and sellers. If the stock market is like a calm boat on a lake, crypto is a ski jet in a thunderstorm. Fast, fun, risky, and you'd better know how to hold on. Up next, what is the spread and how does it quietly drain your profits? Ever try to buy something, but the seller wants more than you offered? That difference in price? That's the spread. In crypto, it's the gap between what someone is willing to pay, the bid, and what someone wants to get, the ask. If a buyer says, I'll give you $5, and the seller says, not unless you pay me six, that $1 difference is the spread. No deal happens unless one of them gives in. In crypto, if you place a market order, you agree to pay the seller's price. If you place a limit order, you wait on your price and hope someone takes it. Market makers use the spread to profit. They buy low, sell high, and keep that gap. It's like a used car lot. You will always buy for more than you can sell it back. The spread is their cut, and it's happening in crypto too. Bonus tip coming next: why volume is your trading highway and how not to crash. Ever try to drive a semi truck down a bike lane? That's what it's like when you throw too much money into a low volume crypto trade. Your DCA bot might be smart, but if the market isn't deep enough, you could wreck your strategy. Here's the simple rule: only use 1 to 2% of a coin's daily trading volume in your entire DCA setup. That means your base order plus all safety orders combined. If the coin trades $100,000 a day, keep your bot under $1,000. Safer still, try $300 to $500. Why? Because thin markets are fragile. Big orders can push the price up or down too far. Slippage eats your gains, and your bot might get stuck with half filled orders that can't recover. Volume is the size of the road. Your DCA bot is the vehicle. If you try to force a semi down a bike lane, you're gonna cause a mess.